If you are planning to retire, especially if you are retiring early and are worried about tax impacts to your withdrawals from savings, it is possible to pay very little to even zero federal income tax as you pull money from your savings. Hi, I'm Chris. I am an IT professional who has become absolutely obsessed with retirement planning and early retirement. Like many of you, I am consuming as much retirement planning information from YouTube channels of certified financial planners and others, their books, blogs, you name it. One of the decisions I have made is that I am going the DIY route, at least for now. Certified financial planners are a good thing and invaluable, and many should definitely use a good qualified financial planner. However, many, like me and many of you, choose to put the work in to manage this ourselves and hopefully save a lot in fees like asset under management fees. That is, if we don't make critical mistakes. In my studies of all the good information that CFPs put out, one of the things that really blew my mind was that with proper planning, it is possible to pay zero tax in some of your retirement years. What makes this possible? You can't just wake up the day you plan to retire and accomplish this. It takes a good long-term financial plan to put yourself in the position to do this. And it really all boils down to this simple fact. You have to build up some of your retirement savings in after-tax accounts like a brokerage or high-yield savings, CDs. What many of you have hopefully done is throughout your career, you've piled pre-tax money into 401ks, IRAs, or for those in the public sector, it may be a TSP, 403B, or 457B. Roth accounts are another category that offer both after-tax and pre-tax benefits and that can play a very important part in your plan. Personally, I did not fully understand this until I was in my late 40s. My wife and I have always had an after-tax account for buying some stocks and having money that wasn't locked behind age-related penalties. But I never knew how critical having at least some of your retirement savings in this type of account was. Ari Taubleib, who has an excellent YouTube channel and is a very knowledgeable certified financial planner, calls this account a superhero account, and for very good reason. I've been trying to accelerate our after-tax brokerage savings as we get closer to hopefully retiring early, and I want to show you a great example of why. And just to quickly recap how federal taxes work, the main federal taxes we pay are on ordinary income and then capital gains on the earnings of long-term investments. Ordinary income is taxed through progressive tax brackets that increase as your taxable income increases. Capital gains taxes also have progressive tax brackets, but currently there are only three brackets, 0%, 15%, and 20%, and which rate you pay depends on your ordinary income plus your long-term earnings from the sale of investments. And one more thing, as we're diving into the first scenario, this is simplified and not meant to be financial advice for your retirement or for your taxes. There are many other considerations beyond these tax brackets like NIIT, net investment income tax for higher incomes, earned income credit, and much more. Use what I'm about to tell you to get an idea, but consult a tax professional for your personal situation. All right, let's dive into the tool for our examples. This is DIYretirementtools.com. Let me go back to the main screen. This is a tool that I initially created for myself. There are many great retirement tools out there that are more comprehensive. I personally use Bolden more for long-term planning and testing out scenarios of what early retirement will really look like. But I also wanted to have more customized tools for specific use cases. For example, estimating withdrawals and taxes. And where, many of us, I'm sure a lot of you have done spreadsheets. I've used spreadsheets in the past for things, but I decided to build what I needed and then share it with any of you who want to use it. You can see the link in the video description for DIYretirementtools.com. We'll have some other videos diving into more of what these tools can do, but for now, let's use the Withdrawal Assistant, which is great for estimating tax on withdrawals from your savings and any other income you may have in a given year. All right, so before we go, just some quick setup. This is the main page before we go into the Withdrawal Assistant. I set up just 3 simple accounts. We didn't have to go into a lot of detail, but just assuming somebody who's had a steady career, and maybe they're in their mid to late 50s, and they've got maybe $875,000 in a 401k, $300,000 in an after-tax brokerage account, and then $100,000 in a high yield savings. This gives us a good starting place to test some scenarios. So let's go over to the withdrawal assistant. Okay, so let's assume that for this first scenario, we're going to do 100% cash. We've got our single filer set up, one household member. I've got some things put in here just for realism. If you've got cash savings, you're going to have interest. If you've got brokerage with stocks, you're going to have some dividends that have to be accounted for taxes every year. But let's just assume that we want $7,000 a month for our expenses, which would be $84,000 a year. So let's say above and beyond our interest and dividends, let's just say we're taking $84,000 out of cash. All right, so what did that do for tax? There is zero tax. And the reason is because we still have plenty of room in our standard deduction. So, when you file your taxes, if you're not itemizing as a single filer, you get up to $16,100. That first $16,100 of your income, of your ordinary income, is not taxed. If you were married filing jointly, that's going to be $32,200. We don't have any capital gains, so we're good. No tax. For our second example, let's look at splitting it into two different withdrawal types. So maybe you're not taking everything from cash, but you want to sell some of your stock in your after-tax brokerage account. So let's divide it up. Let's say $42,000 cash, and then the other half would come from some stock. And let's say you held that stock for a long time and it's got a lot of gains, and you can really save some tax on the gains of that. Because if you look over here in the tax section, you'll see that we're still at zero ordinary tax, zero capital gains tax, zero total tax. We've still got plenty of room in our standard deduction, and capital gains, there's 0% on capital gains because our ordinary income is not enough. One thing I do want to highlight as we're going through these examples that's really helpful is to look down here at the FPL percentage, which is federal poverty level percentage, and that is used in the calculation to determine if you are eligible for affordable health care subsidies or whether you would be forced to use Medicaid. This is going to be really helpful as you go through these tax situations to give you options on what you can do for health care if you're not 65 and eligible for Medicare yet. If I were to go back, I just want to show you an example. If I were to go back to our 100% cash example, of all $84,000 coming from cash, then we have a problem because we don't have enough income to be eligible for Affordable Health Care Act plans. We would be forced into Medicaid, which may introduce some limitations that we don't necessarily want. So just something to keep to keep track of as you go through these scenarios. For our third example, we're going to keep things pretty much the same from our example 2, but what we're going to do is we're going to focus on this remaining cap space that we have in our standard deduction. So all of this area here, this $13,100, if we could have that income of exactly $13,100 or lower, we could potentially, we would pay 0% tax on that. And one way to take advantage of that is through something called a Roth conversion. So this is a great way to convert pre-tax savings to a Roth account, which can move money over and potentially avoid paying some higher tax later, later in life, later in retirement, when you have forced withdrawals from your traditional retirement accounts. But the way it works in general is you can withdraw money from your traditional retirement accounts. You would take it out of your 401k into a traditional IRA, and then immediately transfer that into a Roth IRA. And that exempts you from the 10% early withdrawal penalty. But you do have to pay your ordinary income tax rate on these withdrawals. So, some of the strategies, zero tax may be a little overkill, but you could look at maybe filling up your 10%, 12%, even 22% tax brackets. But today we're talking about zero tax. So we're going to do a Roth transfer for the difference of what we've already got in ordinary income and our standard deduction. So I'm going to do 13,100 in a Roth transfer, and we are going to calculate, and then we're going to go over here and look at our tax. We still have zero tax. Our standard deduction for our ordinary income tax bracket is completely full now. We've gone up to the brink of that. If we make another dollar, that dollar is taxed. But we're still there. We're still at zero tax. Up to this point, we've also done single filer. I do want to show you that if you change that to married filing jointly, that all of a sudden your standard deduction goes up and you've got even more room. You could do another, let's do this. Let's do 26,100. I mean, we've still got room, but you could even transfer more. So the strategy changes based on your filing status. So just keep that in mind. Yeah, if we go back to single, you see we're bumping up into some of these other tax brackets. So that is example 3 for zero tax. For our fourth example, let's say that you're tired of sitting at home. Maybe you want some more discretionary income, so you're going to do some part-time work. So you're still going to withdraw your full $84,000 that you budgeted in your retirement plan, but now let's say we take a part-time job where we make up to $13,100. Similar with our Roth transfer example, we can make ordinary income in a job and be right at the top of our standard deduction, which keeps us at zero tax. And if we're doing married filing jointly, you've even got more room. So if we change that, and let's just say, maybe you make $29,000, then you've got more room for part-time income. So really, your total withdrawal plus other income is now $117,000. $84,000 of it is retirement withdrawal, but now you've got some extra income, but you're still paying zero tax. Our fifth example is going to focus on similar to our example 4, but we also still want to take advantage of the ability to pay zero tax on capital gains for a stock sale. So we're going to set this back. Let's set it back to, all right, we've got it single. Let's put the income back at 13,100, and we're back at zero tax. Okay. Now, what we're going to do is we're going to add a line item. First, I'm going to set cash to $30,000, and then we're going to take the other $54,000. Remember that we're trying to withdraw $84,000 a year for our retirement, and let's make that a massive gain on an after-tax stock sale. You've held this stock for a couple of decades maybe, and it's just got huge gains. And if you had sold this back when you were working, you may be paying 15% long-term gains tax on it, but now that you're retired, you can completely avoid that tax. So now we go over and look at our tax. We're still at zero. We've got $45,000 in capital gains. We are still 0% capital gains territory, and we are still paying zero total tax. So there you have it. 5 examples of absolutely zero tax on retirement withdrawals. We probably will not be fortunate enough to maintain this for our entire retirement, but it's nice for the years that we can do this. Once Social Security hits, or when all of your withdrawals come from pre-tax accounts, then tax is pretty much unavoidable. But this does give you options to plan for this, and maybe you take advantage of this to not pay zero tax, but to pay a lower tax than you would eventually. Speak to a tax professional and a good financial advisor to assess your situation and create a plan. But I hope this helps, and I hope you had the aha moment that I had when I figured this out. Please like and subscribe. See the link in the video information to have access these tools that I've created for free at DIYRetirementTools.com. See you next time.